If you're ready for freedom from the grind, then passive income from real estate investing is the best way to get you there. If you don't know where to start or what to do next, then the Rent Roll Radio Show is the best place to get you there. Join us while we discuss the best practices, strategies, and mindset you'll need and give you actionable content to get you from where you are to where you want to be. Hey, Rent Roll Radio listeners, as always, I'm your host, Sterling Chapman. Today, we are joined by Neil Timmins. Neil is the CEO of the Legacy Impact Partners. Neil, welcome to the show, and thank you so much for joining us.
Thanks, Sterling, for having me. I appreciate you having me here.
Awesome. Well, I really look forward to getting to know a little bit more about your story and sharing it with some of our listeners. Can you start off by kind of telling us your background, how you got into real estate, what you did before it, and what you're doing today?
Yep, absolutely. So back in 2003-ish, 4-ish, well, both years, I was a banker. My mom had gotten to the point where all the kids were out of the house. It was time to go do something. And her and I were talking. She said, well, what do you think I should do? I said, you know what? You'd make a great realtor. And she thought about it for like 10 seconds. So she was like, you know what? I'm going to do that. So that's what she did. She went and became a realtor. We're having a conversation like a year later. I'm still at Wells Fargo as a personal banker. And she's outlining what she's done for the year. And she made twice as much as I did. and I'm like, what in the world? So that was it for me. I was like, okay, well, if she can do that, I can do better. You can tell I've got three brothers. I grew up in a very competitive household.
Hey, I'm the baby of two older brothers.
Okay.
That all played sports, and my dad was also very sports. So the uber competitive nature, I feel you there.
Yeah. Yeah. So that was my entry point into the industry, 2004 as a realtor.
Okay, cool. And how was that as a realtor?
It was, I enjoyed it. There's a whole bunch of things, and you can imagine all of us have experienced this, whether it's in work or some other place. You ever go to a place and you're like, wow, this is like home. This just fits, whatever it is, maybe a school, maybe a restaurant, maybe anything. Right.
Sure.
And that's how it felt. It was going, it just felt like home. Literally the first week I was like, this is like the greatest thing ever. Felt so good. Yeah.
Nice. So how did you transition from being a realtor to being a real estate investor?
Good question. So I found a lot of success in the industry as a realtor. When I was 29 years old, I became the number one RE/MAX agent in the state of Iowa. And so fast forward, a year or two half past that, obviously that means I was producing some dollars and cents. I got to a point where it's going, I need to employ these dollars. So what should I do? I had fixed and flipped a few here and there, like that 2009, 10, 11, 12 era, 13, somewhere in that range. Just as I see something, I go, oh, okay, cool. I'll buy that. And let's flip it. But I never kept anything until 5 years ago. So 2017 was the first year I decided to keep anything. So that's what I did. I just picked one up. I was like, you know what, let's just try it. And that's what I did. And I was like, you know what, this is kind of, I bought a quality asset, a house. And I was like, this is kind of easy. So let's do another one. And I was like, this is kind of easy. So let's just start doing some more. And as long as I kept buying quality, for me, that meant solid B class rental properties, good areas, good rents, good tenants. It was, I want to say easy. I put that in context. It's relatively easy, right about that. Sure. So that just led to one thing after another. And I was going, you know what, let me morph my business out of being a realtor and into being an investor, because I'm tired of trading dollars, time for dollars.
Sure.
And so that's what created a greater focus in terms of investing. We still do a lot of single families today in flipping. Our taxes are a little, depending where your audience is, they may appreciate this. Our taxes, property taxes are super wonky. We've got about 13 or 14 suburbs here. Every municipality has its own tax, millage rate. And so some areas, I'd have to leave 50% loan to value in place to get it to cash flow to make any sense. And most of the times I'm not willing to leave that level of money in it. So that's why we end up flipping and just keeping the ones that make sense.
Yeah. So it's funny. You said you started with a few flips and then decided to keep them. I hear that story a lot. I did the opposite for for whatever reason, I bought like 70 rentals, and my motto from like day one was to never sell. And then as we kind of came up towards the end of last year, I realized like I could make a lot of money if I sold some of
Yes,
these
correct.
houses.
Correct.
You know what I mean?
Yep.
And so I built my rental portfolio before I ever even considered flipping. And now everything I buy,
Great.
I want to flip. I just want to flip it and move the money into apartments.
Yes. Yeah,
Um,
exactly. Well, you're strategically doing that, rolling them up into, what it sounds like is you've identified an asset that you can make money on, but don't want to hold. Your money wants to go into a different bucket, a forever bucket that is not the same asset.
Sure. And I'm not selling my first rentals that I acquired. What I'm doing
Sure.
is I'm finding houses now that
Yeah,
probably don't make sense from a cash flow
that's right.
standpoint, but there's a ton of equity. And
Yep.
and I don't feel like I'm violating my principles of never sell, because like I'm not selling. I'm just moving the money to another real estate. I'm not like
Right.
cashing out and going buying a Lamborghini. I'm going and
That's
like
right.
moving it to another real
That's
estate
right.
asset
Yep.
that's still growing and appreciating. So I feel good about
No,
that.
so I've got a similar methodology to you. It's either we keep the single families that do budget, that do make sense, that you'd want to keep. Otherwise, I roll up into commercial real estate and acquire commercial real estate for cash flowing purposes.
So I want to get into that because I have a
Yeah.
ton of questions about the commercial. But before we do, how are you buying all of your single family houses? So like your rentals that you did keep, like
Mhm.
were you putting down payments down, or were you doing what we call the Burr method? Were you buying like distressed properties, fixing them up? And then tell us a little bit about that.
Yeah. So how do I end up financing the properties in which I do portfolio? That's the question.
Mm-hmm.
Okay, good question. I've got a really good lending relationships with multiple people. So what I typically end up doing is one of two things. If it's a light remodel, I'll literally go out and finance 100% of the purchase price from a local bank, either on a 5 or 10 year arm fixed rate for 5 or 10 years, with a 15 or 20 or 25-year AM. Just depends on the asset and how aggressive I want to get on the pay down schedule. And if it's a light one, I'll go in and do a remodel, and that's it. The money on the remodel comes out of my pocket.
Mm-hmm.
If it's a heavier remodel, I'll do the exact same thing. Or in some cases, we'll pay cash. I'll go in, remodel it, tenant it, and go back to the lender and then pull to the Burr, pull all my money out.
Sure. Okay.
Yeah. And
Well,
then, like a lot of people, I think, when you end up getting, I've maxed out my max loans from Fannie Freddie, right? So I'm at 10,
I
all the
never
30-year.
touched them.
Oh, well, the 30-year fixed rate has been, is great when I'm at 3.25 or 3.5 plus or minus on a 30-year fixed. And I maxed all those out early on. That's where I started.
So I started with that same, like when I started, I remember my first couple single family houses. Like I went and put like 15% down and did
Yeah.
the Fannie Freddie,
Yeah.
and I was getting like a 6.1% interest rate because for
Yeah.
investment
Right.
properties. And then somewhere along the line, a couple years in, I started dealing. First of all, I started dealing with commercial banks with those 20-year and 5-year balloon
Yep.
products, and I did that for a couple of years. And then I stumbled across these like private hard money national lenders that were doing 30-year fixed at like 3.75 or
Sure.
4.25. I'm like, well, I'm not going to go get an enema from Fannie Mae when,
Correct.
these
Correct.
asset-based lenders aren't even
Yeah.
asking to see my damn tax returns.
Correct. Yes.
So I just never went back.
Yes.
Although I will say, we've had a rough week. I don't know when this is going to air, but as of April 21st, the interest rates are soaring, and
Yeah.
my asset-based lenders are talking crazy and wanting 8% and all
Correct.
this. So I might revisit that.
Well, you're spot on. It's tremendous heavy lifting to be able to get the Fannie in place. I end up with the same difference, a different banker. I go to the same gal. She knows all my stuff. They use the same underwriter internally. So they know my tax returns, which can get complicated. So I'm in communication with her. So I just maxed my stuff out last year when I shuffled around some refinance stuff. And so I just was in touch with her to go, all right, this is what it's going to look like. What are you going to need? And just try to knock it all out in a single year.
Yeah. So what do you, this is a question that, and I, a lot of the the show is always just me asking questions I want to know the answer to.
Yeah. Yeah.
But I have bought all these cash flow and rental properties,
Yep.
and we really don't know like how much they're making, right? We can do like a pro forma, and you can like budget a certain amount for CapEx, but realistically, like to get a solid handle on it, you got to look back on a couple years of data, and we're just, we're really never there.
Yeah.
So, I mean, this early in the game. So my question is, what makes a property cash flow for you? How do you compute that? And, what is your criteria for wanting? So I'll tell you what I do, and you can, and this is the kind of the answer I'm
Yeah.
looking for. So
Yeah.
off the bottom, I take principal, taxes, insurance, and principal, taxes, and insurance. Yeah. And then off the top, I take 20% for property management, vacancy, and repair.
Yep.
And I'd like, a couple $100 in the middle, right? I'll take 100 if I got a good amount of equity in the project, right?
Yep.
But if there's not a good amount of equity, or it's in a rougher area where it's not really probably going to appreciate, I want that. I want a little bit more, cash flow.
Yep.
How do you approach that conversation?
So great question. So very similar analysis, right? You got to take out PITI. So I'm running that budget and then taking out for budgeting for management and expenses associated with the property. I put a line item in there, depending on the age of the house. If the house is every property is a little different. So I've got to run a budget a little different. If a house is, let's say it's 30 years old versus a house that's 60 years old, that 60-year-old house could end up with a bigger line item for ongoing management or maintenance, that is. And then it also depends on how much we've touched it. So if we buy in and go in and we don't ever do a full gut, but we do a significant remodel, I can skinny that up because I know we touched about everything associated with that house. Versus, where it's a cosmetic remodel, I know something's going to go wrong sooner or later. There's going to be odds and ends that just add up. And I'm with you though. So when I run the numbers, I'm looking for a house to cash flow at 100% loan to value, and I got to make at least $200 a month.
Okay. And
that makes it tight for the ability to do it, to sit in that bucket. That doesn't mean I don't ever put money into the thing or leave money in the thing. It just means I'm looking for this thing for it to make sense. Sometimes, on a 70-year-old product that's, my market's called $100,000, might rent for $1,000 a month. I'm going to end up in a commercial loan there with a 20-year AM plus or minus, versus some of the better stuff I've acquired over a period of time, where it's a nicer area, it's a newer area, it's more money, but I'm going to end up on a 30-year fixed rate because I was strategic about how I put those things into place. That obviously dramatically impacts the computation as you go there, because the PITI being one of the line items, if not the most significant line item in the equation.
What is your, I know you said it's a range, but like, what do you typically, what does that line item generally look like if you combine vacancy management and repairs?
So vacancy, I typically budget at 5%. Management, typically 7%. Repairs, it varies. So I'll give you that one. It's about $800 to $2,000 per house per year.
Okay.
Some of the houses are, 16, 17, 18, 19, 2,000 square feet. It doesn't take long to spend some money there. Right.
So around the 20%.
Yeah. I think you're fair, because I was at 5 and 7. So you're at 12 there. And then if you're talking 8% on the thing, and you've got, you're hitting $15,000 to $20,000 a year in gross rents, 12 to $20,000, somewhere in that kind of range.
Nice.
You're at 1,000 to 2,000 pretty quick.
That always makes me feel better. I always wonder if I'm not being conservative enough. So I always ask guests that have a similar type of approach to their portfolio, how they do that. Tell me about your commercial stuff. How did you make that transition? What does that look like? What kind of products are you buying? How are you buying them?
Yeah. So much like how I got into keeping single family rentals, I was going, well, I've got some money needs to get placed. Where do I go? And how do I do it? And that was ultimately led me to that path. similar thing occurred where I was going, well, I've got money and we got rentals, but now at some point it's only so efficient, which means not efficient at all, to try to buy a bunch of rental properties. It's not so easy.
Sure.
You know, if you want to go buy 10 this month, it's way easier to just buy one commercial property, right?
Sure.
And so that's what led me down that path of buying commercial property. That, and then we already know this, I think collectively in real estate, the tax benefits are tremendous for all of us in real estate, especially as real estate professionals. And so the timing of that relative to going, well, I can write off a whole bunch of stuff utilizing cost segs and in commercial real estate is awfully attractive. So that's what led me down that path. My first entry point was a warehouse, triple net deal, tenant occupied, very long-term lease in place. And then that led me to, a retail piece was the second one that I acquired. In fact, that was about 2.5 years ago. We just went under contract on a resale of that about 8 or 9 days ago. So we'll see how that wraps up here if they get through due diligence and finance and whatnot here in the next 60 days. So more retail and industrial. Picked up a really sweetheart office deal in December, which was a great one. And the benefit of that for us has been, through half a dozen assets, I've been able to out earn from a passive income standpoint my single family portfolio, which took me 5 years to put together, of nearly 50 units, plus or minus about 45 units. Mm-hmm. It's become more efficient, and it's just a lot easier to put it together for us. So internally, we're moving in a much more focused avenue to acquire more commercial assets and bring on investors at some point when it's makes sense. To date, we've never taken a dollar from any outside investor.
So how are you buying them and financing the commercial buildings? What does that look like? Like, how much are you putting down? Like, what percentages are you putting down? What type of amortizations are you getting on that debt? What type of, how do the interest rates relate?
Yeah. So I'm going to I'll answer that, just kind of go through a couple of assets. And then why don't I tell you a story? Because this will be a fun one for you and the audience. I think the most recent one we just closed on. Typically I'm trying to lock in, commercial rates as long as I can. So you'll typically find me, I'm at 10 years on a fixed rate on everything, because, although I could offset and, you can take a little lower rate on a 5-year, I don't want the risk associated with a 5-year rate. You already see this, what we're experiencing today, right? I mean, the 10-year treasury has doubled from December to today. And so it's dramatically impacting rates. I don't want to ever find myself at a point where I'm going, oh no, it's time to refinance. And I don't have a lot of lead time. And all of a sudden the rates are doing just like what you said today. Guys it's very different than what it was 3-4 months ago. And so I want to allow myself a longer lead time. Amortization schedule, typically 25-year. I've done some things at 20 years. I have the one that we're under contract to resell at this time. When I did the refinance about a year ago, I put it on a 7-year fixed rate with a 15-year amortization. I knew we weren't going to, knew I wasn't going to hold it for 7 years. So I got a little more aggressive on it. And that, consequently, the rate got lower. Mm-hmm. We've got a Dollar Tree in the portfolio. The benefit of having publicly traded, credit tenants is that you're able to negotiate a lower rate, because I'm dealing with my tenant is a publicly traded company. They're a credit tenant. It's not like any other property that we have, right? An apartment or somebody who's there, or a local credit tenant. I mean, it's a national credit tenant. So as a result of that was from a banker standpoint, they absolutely love that deal. So that was an easy one to put in place. Down payments, you asked about that. Typically 20%. Trying to think if we've done anything with 25. Typically 20%. I'm going to tell you 2 stories. I bought the retail piece, which we're reselling. I bought that at the end, like 2.5 years ago. It was the end of the year. It was December. Both I and the seller, wanted to get this thing done in the calendar year, but we were too late for me to go get a loan because of the time frame associated with coming to a, essentially a handshake agreement the first week of December. I'm going, there's no way I'm going to get this thing closed from a loan standpoint in December. So I bought it from them on contract. I want to say it was a 60 or 90 day contract, knowing that I'll have it refinanced out in the 60 or 90 days. So I put 10% down on the thing and agreed to refinance it in 60 days. Went to my lender, did the whole thing, appraised the whole thing. And that thing appraised for about, let's say 10 or 15% higher. I don't recall it exactly, but at least 10% higher than what I was paying for it. So nice. I didn't put down anything else. All I put down was 10%.
Nice. Now I've got one, the most recent one we just closed on this December. So just a few months ago, it was a package deal. So what I mean by that, it ended up being 3 different medical offices, 3 different locations here in Central Iowa. And it was a non-uniform portfolio. So total portfolio, and I'm rounding here, so bear with me, that was about $9.5 million. One of the assets, though, in that $9.5 million total of the 3 assets was like $7.9 million. Mm-hmm. So overwhelming is the lion's share value of the whole portfolio. So what I ended up doing was making an offer on the entire portfolio. This thing was public. So it was listed by a broker, came public. Multiple people made offers on pieces of the portfolio, but the seller did not want to sell it that way. They wanted to sell the portfolio as a whole. Mm-hmm. So what I ended up doing is making an offer on the whole portfolio, get it under contract, and then the monster, the $7.9 million value associated with that portfolio. What I ended up doing was wholesaling that off. I was able to connect with another broker here in town who had a buyer who just wanted that one piece. I wholesaled that piece off. I retained the other 2 offices. So that put me at about, let's call it $1.6 million to purchase the 2 other offices. When we went to close and do all the lending, it appraised at 2.5. So I'm under contract at 1.6. It appraised at 2.5. I went to closing, and it ended up being, as a result of that, with my relationship with my lender, a no money down deal. I did not put a penny down into the property. And I put that on a 20-year AM, which was my 2. He would have let me do either one. I just wanted to get a little more aggressive with the AM schedule on a 10-year fixed rate. Oh, that's awesome. That's awesome. So what's next for you?
Next for us, our bread and butter here is literally single family homes. Just that's kind of just as you alluded to. I mean, that's the thing that we go in, fix and flip, and just keep rolling dollars. Strategically hold single families when they make sense. But for us, it's primarily just generate the dollars and focus on commercial. Put in our dollars and cents to work to employ cash flowing commercial assets, or commercial assets in which we can reposition one way or another, either through a physical improvement, through a management or restructure, through some component of value add, to be able to reposition the asset and keep it. And so the intent on this retail, which is under contract, is to do a 1031 to buy another asset.
Awesome. Any advice you got for somebody who's just getting started?
Ooh, just getting started. I mean, continue to take action, continue to move. If I was going to advise my younger self, it would be go straight into commercial. The numbers are
all the time.
Yeah. It's just the efficiency associated with this, as you know, part of the single family, and I got a lot of them, so I'm not knocking it. It can be very positive, but part of it is, there's some brain damage associated with just all the stuff that one has to deal with. Again, when you go, you can, if 10 houses equals 1 commercial asset, I'm just going, I'll just take the commercial assets.
Yeah.
It's more efficient. It's just easier. You deal with professional, I'm dealing with some things we self-manage, but some things where there's just a little too many moving pieces, we go external. I'm dealing with very professional property managers. Counter that with the single family side, that world does not look the same.
No, for sure. You mentioned taking on other investor capital. Is syndication something you've looked into?
Yes, I'm intimately familiar with syndication and in my exposure with other folks who syndicate. Sure. So yes, yeah, absolutely. And that'll be where we're headed. That is where we're headed this year, is to continue to grow our commercial asset base and move upstream, if you will. So bigger dollar deals.
Sure.
And to bring on folks when it makes sense. And I think part of that has been my slightly my reluctance to bring folks on is, and will always continue to be so, is I'm not knocking syndicators here. Everybody's got a little different business model, but I don't need to make a living by putting a deal together and feeing someone. Does that make sense? My goal has always been to employ my dollars and cents in an efficient fashion to generate cash flow, to generate passive income. So the assets we would bring on now or in the future with somebody else, I've got to be on board for my ability to go, with or without you, I'd want to buy that deal.
Sure.
Right.
Yeah, no. I mean, there's a lot of that. I mean, there's a lot of both of it in the marketplace, obviously. I mean, there's syndicators that are buying deals and living off of asset or like acquisition fees.
Sure.
And that's kind of their way into the game. And then there's the other syndicator who wants to buy bigger deals and just can't do it with just their money, right? We in our projects, we invest a ton of our own money. I mean, and it makes us more money paired with their money than it would just if we found a much smaller asset because of all the operational efficiencies and of the much bigger deal.
No, but you're right on. And neither one's wrong. I just know from my comfort level, every time I talk to a syndicator, and ask them how much money you putting into the deal. And if I ever hear none or 1% of the total capital, for me, it does not, and everybody's different and that's okay. It just doesn't give me a comfort level for me to go, I want to be part of that.
Sure. Absolutely. No, we I think we put in, as a general partnership team, I think we put in like 15% in our last two projects.
Yeah. Well, you typically see 10 to 20% is pretty, call it old school commonplace, right?
Yeah.
And you've got real risk on the line. You've got real dollars.
Sure.
Yeah.
Absolutely. So, one thing I also want to ask everybody about in our current environment, and again, I hate, I hate my podcast airs 2 months after like we record it.
Oh, sure.
Such a backlog.
Yeah.
So we'll know if you're right or wrong by the time it comes.
There we go.
It's funny. I interviewed a bunch of people during like when COVID was just kicking off, and they had these crazy predictions. And then like by the time the episode aired, it was like totally irrelevant and moot points,
Right.
But we are seeing the Fed hike rates, and it's causing kind of, it's definitely impacting our lending.
Correct.
What do you think the broader impact on the housing market will be? Do you think we're so low in supply that it'll just keep on trucking for a few years, or do you think that this will have some devastating? What do you?
Yeah,
what's your economic forecast?
It's a great question. I think my answer is contingent upon how high they continue to move rates. Because right now, the supply and demand factor, at least in my backyard, is so far off whack that this movement from what was on a consumer 30-year fixed rate that was in the 3 or 3.25 in December is now right at 5. But that it is not, there's no impact on what's transacting. But there's just so much activity from a supply demand factor standpoint. So I think it's got a lot of legs. Our resale inventory is only about 30%. So in my backyard, only about 30% of all the homes available for sale are resale single family homes. So that tells you 70% is new construction, and new construction prices continue to increase, right? They continue to increase because all the inputs continue to increase.
Right.
So it tells me, if 70% of all inventory available for sale is new construction, and those prices have nowhere to run but higher because all their inputs is just a function of inputs, right?
Sure.
To me, that says resale prices are going to continue to go. And the supply and demand factor, just because there isn't much for sale, they're going to continue to run higher. So I think prices still run. I think even if interest rates find their way to 6 or 7% this year, which would not be, 6 is not out of the question. 7 might push it. I think there's still room to run over the next couple of years.
Awesome. Love hearing that.
Yeah.
Real quick, I want to hop over to our radio round to help our listeners get to know you a little bit better.
Yeah.
So first question is, what's your favorite book?
My favorite book, it's a book that changed my life. I was probably 22 years old when I read it. The Millionaire Mind by Dr. Thomas J. Stanley. Okay. He wrote The Millionaire Next Door, which is his most popular one. Yeah. But The Millionaire Mind, incredible book.
Okay, I've read The Millionaire Next Door. I've never even heard of The Millionaire Mind.
Yeah, all about how to think, how to walk, how to act, how to talk. All what's on the inside of the millionaire's mind.
Awesome. I'll have to check it out. I have to add it to the Audible list. Next question is, what's your favorite quote?
My favorite quote, try not to be a man of success, but a man of value. Ben Franklin said it.
I love it. That's a great one. That's that is a struggle amongst high achievers, right? I first noticed that climbing the corporate ladder in corporate America, when I was early on, I admired and looked up to the uber successful people. And then like, as I climbed the ladder and interacted with them more, I'm like, I began to think very low, you know what I mean? Yeah. And stopped assigning value to people based on their success in life. And then as you become more successful, you think, well, how do I become more of a better father, a better family man, a better, member of the community?
No, you're absolutely right. But at the same time, I think one becomes, from a business perspective, one becomes successful by being of value. So from when I was in the position to serve folks, as a real estate agent, buying and selling homes is literally what can I get for them? How do I serve them? Because if we serve others properly, we always get what we want or what we need. Absolutely. Yeah.
That's the old Zig Ziglar. You can get everything you want in life if you help enough other people get what they want.
That's exactly right.
What's your favorite thing to do outside of work?
Favorite thing to do outside of work is hang out with my kids and all their activities. I've got 3 kids, 16, 14, and 12, and they're all in sports. And so I just love being at every single thing that they do, whatever it is that they do.
Awesome. I have a 2.5-year-old and a 1-year-old.
Okay.
And we want another one, but we're going to wait a couple of years. So I'm about a decade behind your trajectory right there.
It's, my perspective has changed from where you are to where I am. Because right now I can see the light at the end of the tunnel to go, this thing's almost over. I mean, my kids will, at some point they're not going to play X anymore. Right.
Yeah.
And so I'm going, I only got a handful of years left. So I don't miss a single thing. I see everything.
That's awesome.
Yeah.
That's awesome. It's great that this lifestyle that we've chosen in real estate investing allows us to do those things.
You're exactly right. Yes. It's a privilege. Yep.
Good deal.
Hey, by the way, that runs right in line with Dr. Stammer's, the book I mentioned, The Millionaire Mind. He said, vocation. The number one attributing factor to one's financial success in life is their choice of vocation.
Yeah.
Tremendous. Yeah.
How can our listeners get in touch with you, find out more about you?
Well, you can find me in a couple places. You can find me on Facebook, Neil Timmins. You can find me on LinkedIn, same spot. I'll make sure I get you the link. My website, Legacy Impact Investors. And then I host a podcast as well, Real Grit Podcast. And so you can find it everywhere podcasts are disseminated.
Awesome. Well, Neil, thank you so much for joining the show. I really enjoyed getting to know you and look forward to keeping up with you on your journey.
Likewise. Thanks for having me on, Sterling.
This episode was brought to you by Crestworth Capital. If you're a busy professional and ready to make passive income from real estate investing, then go to crestworthcapital.com where you'll be able to download a free copy of our ebook to help you get started today. Until next week, happy investing.